Hello and welcome to Chapter 11 in Managerial Accounting. This is reporting for control. The learning objectives for today are as follows. We're going to be looking first at segmented income statement. Then the next two videos will look at responsibility centers, that is cost centers, profit centers, and investment centers, and analyzing their ROI. Then we're going to end this chapter with looking at the balanced scorecard. So this will be kind of an overview. You'll be using items and concepts that you learned in earlier videos, earlier chapters, all kind of smushed in together. This is our leveling off, okay? We're going to be learning some new concepts, but mostly those concepts will be layered on top of the existing ones and providing a new lens onto them. And that is the same as next week, where we will once again be looking at relevant and irrelevant costs, something that came up when we talked about opportunity costs, sunk costs in one of the first few weeks, but then we're going to be using them for additional decision making. So again, layering on what we've already done, but not necessarily brand new content, but rather a different way to look at the existing content that we've looked at. All right, so without further ado, let us look at learning objective number 1, segmented income statement. So first reason why we'd look at segmented income statement is looking at when would we do this? And we would do this in decentralized organizations. So ones where the power is decentralized to different managers that are running different departments. So what are some advantages? Well, in decentralized organizations, by delegating that day-to-day problem solving to lower level, i.e. lower paid, managers, top management can concentrate on bigger issues such as overall strategy. By empowering lower level managers to make decisions, puts the decision-making authority in the hands of those who tend to have the most detailed and up-to-date information about day-to-day operations. They are, quote, boots on the ground. That way, by eliminating decision-making and approvals, organizations can be more nimble, acting more swiftly to customers and changes in the operating environment. As well, this helps the decision-making authority to train lower level managers eventually for those higher level positions. So you can kind of hire and promote within. This also empowers lower level managers to make decisions that can increase their motivation and job satisfaction. They feel bought into the program, bought into the company, and are more likely probably to spend their own time thinking about solutions for work, as well as they're better equipped to and better motivated to use their time at work to solve work problems. Okay, some disadvantages. These lower level managers, they may make decisions without fully understanding the company's overall strategy. They might do what's best for them and their division without understanding how this all fits into the overall corporate structure. If these lower level managers make their own decisions independently of each other, that coordination, that kind of special sauce of the company could be lacking. Spreading innovative ideas may be difficult in a decentralized organization. That is, someone in part of the organization may have a terrific idea that would benefit other parts of the organization, but without strong central direction, this idea may not be shared with or adopted by other parts of the organization. Lastly, lower level managers may have objectives that clash with the objectives in the entire organization. That is, a manager may be more interested in increasing the size of their department, leading to more power, more prestige, than they care about increasing their department's effectiveness. So they have the power to hire people, they do hire people, even though maybe it doesn't help out the company totally. So now that we know kind of when we would use segmented reporting, decentralized organizations, let's talk about how we're doing that reporting. Segment reporting. Segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. A segment can be an individual store, a sales territory, a service center, or any other kind of thing that makes sense. It could be a product line. Corporations could segment their business by customer channel, by geographic region, like I said, by product line, however they would like. I tend to see product line or geographic region. An operating segment for financial accounting purposes is a component of an enterprise that engages in business activities from which it may earn revenues and incur expenses, whose operating results are regularly reviewed by the enterprise's chief operating officer to make decisions about resources to be allocated to those segments and assess their performance, and for which we actually have discrete information available. So that is kind of what is required for reporting purposes. Segmented statements can be prepared for different levels of activity in an organization and in different formats. And sometimes we use the contribution format because it separates fixed costs from variable costs and enables the calculation of a contribution margin. However, remember that when we use a contribution margin income statement, that is a non-GAAP measure. So if we're if we have to report for GAAP, so for example, International Financial Reporting Standards, we would likely use a segmented set of financial statements as we're required to. If we have those, those business activities that earn revenues and incur expenses, and that information is available and that it makes sense to do so. So we would probably do that in your traditional income statement format for reporting purposes, but then maybe there's a second set of financial statements using the contribution format for internal business and decision-making purposes. Let's look at what this may look like as an example. So we have levels of segmented statements. Perhaps we have Webb Inc., and they have a computer division and a television division. And we can create a separate income statement for each division. So here we have our total income statement for the television division. So we still have a contribution margin. It has sales less our variable costs equals our contribution margin less our traceable fixed costs. That is fixed costs that are traceable to the television division. And that gives us our division's segment margin. All right, so continuing on, you'll notice that contribution margin is still calculated the same. And then when we look, we're like, oh, cool. Like this is the amount of profit that the television division contributes to the overall company's bottom line. So they are profitable by $60,000. So zooming out, if we look at the total income statement, we have our television division, which we saw with our division margin of $60,000. We then have our computer division that has our profit margin of $40,000, and together we get the company's income statement for $100,000. But I said before we had traceable fixed costs. We're also going to have common costs that cannot be traced to individually the television or the computer departments. So then we have to take into consideration common costs that cannot be traceable to either division. And then we have our overall operating income of the total company of $75,000. So my question to you is, if we eliminated the television division, would we be better off as a company? No. If we eliminated the television division, our operating income would be $15,000. We would just take away the 60, we're left with 15. That wouldn't be good. Likewise, if we eliminated the computer division, we would be overall at $35,000. So all in all, while the television division is more profitable on a kind of like overall net division margin basis, they're both profitable because they're both positive numbers here. Where it gets a little tricky is when we have different permutations and combinations, but come back and, take a screenshot of this, really think through what do all of these mean? Where do they come from? What is the difference between our traceable and our common fixed costs? And what can we eliminate and what can we not? In order to do just that, let's take a look at assigning costs to segments. So how do we figure out what are we going to allocate to computer division? What are we going to allocate to our television division? We have some guidelines. So when looking at assigning costs to the various segments, we need to look at what is their cost behavior patterns. That is, are they variable costs? Are they fixed costs? And can we directly trace those costs to the segments involved? Traceable fixed costs should be separated from common fixed costs, as we saw, such that we can enable that calculation of the segment margin of that division profit margin. The traceable costs arise because of the existence of a particular segment and would disappear over time if the segment itself was eliminated. So for example, you might have fixed costs of a warehouse manufacturing plant that only produced televisions. Well, if you got rid of the television division line, eventually you wouldn't need that warehouse anymore and it would be eliminated. Conversely, there are common costs that arise because of the overall operation of the company. And those would not disappear if we got rid of the television division. For example, CEOs, CFOs, and the head office rent, and head office coffee budget would not be eliminated if we got rid of the television division. So those are common costs to the entire company that cannot be eliminated. And as such, common fixed costs are not allocated to segments, whereas traceable costs are. It is important to realize that the traceable fixed cost of one segment may be a common fixed cost of another segment. So for example, the landing fee paid to land an airplane at an airport is traceable to the particular flight, but it's not traceable to first class, business class, and economy passengers. So really just kind of taking a step back and assessing what are these inputs and what do they mean in this given context. Not really something that can be memorized. As long as you understand the framework, it's about applying and really demonstrating the competency of that knowledge. Same, but different. We might have traceable costs that are traceable to the television division, but just like in our airplane example, we might have those traceable costs to the television division, but then they become common costs for our regular TV and whatnot. So our television and our regular TV are two product lines of the same division. Let's go take it one step deeper. So now you can see we have our television division, which in a few slides ago was one of our divisions. Now it is, I don't know, the thing that rolls the two divisions up. We're further segmenting this income statement. It's still in our contribution margin format. Except we're delving in a little bit deeper. So together we still have 300,000. Together it rolls up to the same as the total television division. But now we are separating the sales that are allocated to the regular TV, the sales that are allocated to the smart TV, their respective variable costs, and as well as the respectable traceable fixed costs. And from there, you'll notice that there's still $10,000 that cannot be directly traceable in fixed costs to either the regular TV or the smart TV. So these are common costs. Maybe there's a bit of a common supervisor for both the regular and the smart TVs, a portion of their salary, etc. That cannot be directly traced to one segment or the other. So then it's going to be a common cost for the division. And so what this tells us is, cool, if we got rid of the regular TV segment or we got rid of the smart TV segment, what dollars we would be out. So how are these costs relevant to the total picture of the television division? Because both of these are positive, both of these should be kept as far as the information that we have upon first glance. Okay. Friendly reminder of our GAAP financial standards. As I indicated before, one of them is IFRS, so International Financial Reporting Standards. So this is IFRS 8 for operating segments. That requires segmented reports to be prepared for our external users under a certain set of circumstances, and they follow the same methods that we have discussed here for internal segmented reports. However, friendly reminder that in order to be IFRS compliant, we need to use the traditional income statements. So it would be the same thing that we saw, except instead of breaking it up into variable costs and fixed costs, it would be breaking it up into our cost of goods sold and our general and administrative costs. So our product and our period costs. But it's always a bit about trade-offs. So just because the traditional income statement complies with GAAP and it's what we can report externally, does not give the managers the information that they would need internally. So it really is a trade-off. Most companies of a certain size would likely do both. Okay, time for a quick check. How much of the common fixed costs of $200,000 can be eliminated by eliminating the bar? So please, friendly reminder to pause this video, give this a think, and then come back and we'll discuss it in the next moment. Welcome back. All right, how much of the common fixed costs of $200,000 can be avoided by eliminating the bar? So common costs, $200,000 by eliminating the bar. If you said none of it, you would be correct. So that is, if we go back a slide, this is the common costs. We have no idea. These haven't been traceable to the bar or the restaurant. So like maybe none, likely none. Because if we knew there could be some, they would be in the bar part, right? So it's going to be none. All right. Another quick check. Suppose the square meters is used as a basis for allocating the common cost of $200,000. How much would be allocated to the bar if the bar occupies 1,000 square meters and if the restaurant has 9,000 square meters? Okay, interesting. So now how much could we eliminate of those $200,000? We have a total of 10,000 square meters, and 1,000 or 10% of the 200,000 could then be allocated to the bar. So what that indicates to me is give it a think, pause the video, and come back and we'll talk about it. All right, if you said then if we had 10% of the costs allocated to the bar, then we can eliminate 10% of the costs, and that would be correct. So if we had an allocation basis, that's reasonable, right? And this is like the bar takes up 10% of the square space. Great, let's allocate the common fixed costs. And if it got eliminated, then the bar costs would no longer be there. And in theory, the common costs would go down. Otherwise, why are we allocating those costs to the bar if they are not relevant? So that is why the basis for the 20,000. All right, so a little bit of, I want to say tricky in the sense that we're applying things that we've seen in previous chapters in a new context, so with some new rules to layer on. However, the underlying foundation is already there, already solid if you put in the work, and getting more solid. So even if you put in the work, learning is repeated exposure to same or similar materials. So you can get even stronger at elements that you knew, or even stronger elements that were a little bit shaky, and by revisiting this. So friendly reminder, while I will see you in the next video, please consider utilizing your resources that are available to prepare for your final exam. That includes booking office hours with me, going to see Prof. Lee, going to your tutorials, seeing TAs in office hours, and utilizing the discussion boards. And of course, doing some practice problems, as those are always a great way to get in some reps with this material. Alrighty, thank you so much. I will see you in the next video.